You're listening to the Serial Entrepreneur Hour, Club Hour, now podcast as well. You can listen to this on your favorite podcast channel. We are Startup Club, by the way, approaching 1 million members. We're very excited about that. If you're not already a member of Startup Club, feel free to click on that greenhouse just above and join the club. Today, we are talking about raising money for your startup. So if you're in the audience and you're thinking about raising money, we want to hear from you. It's going to be an exciting topic. I know this is a topic that Jenny Kassan has talked a lot about on Clubhouse. She has a session on Clubhouse, and she does it every Tuesday at 7 o'clock. Is that right, Jenny?
Sorry, 7 o'clock Eastern. Yeah.
Yeah, you're Pacific, right? Yeah, so I should always,
Oh,
you know,
yeah. I
let's
was thinking.
exactly. Easterners, we think the same way, and you're in Pacific, you think that way as well. But no, let me tell you this. I've been through 25 years and about 10 different companies, and we've raised money in so many different ways. Uh, and we've done it with venture capital. We've done two IPOs. We've done Regulation D, and we did a private placement memorandum. We did angel investing. We did government funding. So we've just sort of covered the gamut, but it can be very, very confusing. And so we're going to try to take this apart today. We're going to try to understand what's going on in the world of raising money. I know we're going to be a little bit focused on the American side because we have Jenny here as well. And I know that Jeff and I work for a company called paw.com, and I'm also invested in a company called Hip Optical. And with these companies, we're actually looking at raising money in 2023. I know the environment may not be the best right now, but we are looking to raise money and really understanding the nuances of it. What is the risk associated with these types of investments? Are we first in line or are we last in line? I'm involved in a company, Jenny, which raised 60 million in venture capital, and the owner and one of the investors called me in a couple of years ago to see if I could help turn the company around as board of director. And quite frankly, it's a challenge. But the sad part about it is that the owner, who spent 15 years of his life working and building this company, has pretty much been wiped out. There's almost, maybe a 1% chance the owner will ever get anything. And he's not even working for the company anymore. So he doesn't even make a salary. Well, our co-moderators are Michelle and Jeff today. Michelle, it'd be great if you could set up the moderating for Jeff and myself and Jenny, and we can get started here. I'm hoping you're not having technical difficulties. I know you jumped in and started the room
I'm
pretty
good.
early. Yeah, could you
I'm
get?
going to assign you as moderator. Just yes.
All right, awesome. So, as we kick it off, or before we kick it off, if you're in the audience again and you have a startup or you're thinking of raising money, this is an unbelievable chance for you to ask one of truly the best experts that I know when it comes to raising money from a legal perspective. Jenny, I hope I didn't confuse everybody right away with Reg A, Reg D, dot, 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 dot. I mean, can you just sort of give us a 2-minute primer on, starting with angel investing, you know, down to, I guess, venture? I mean, I don't think we'll be talking about IPO, but
Wow, 2 minutes. Okay, well, let me share my approach. When I think about fundraising for a business, especially from a legal perspective. So I think of it this way: there are two decisions that you need to make from a legal perspective. One is, what is it exactly that you're offering to the investor? I know in the world of venture capital, when you're raising money for a typical, high growth tech startup, you really don't have any say in that at all. It's the investor that hands you the term sheet. Usually they're going to tell you how they're going to invest in your company. But because I specialize in helping people raise money on their own terms, I think it's very important for the entrepreneur to decide, what is the best way for me to accept investment from investors. And that could be some type of a debt instrument, revenue-based debt or regular debt. It could be equity, but maybe it's a type of equity where your investors can get paid even if you don't have an exit. Maybe it's some kind of a convertible instrument. There's really an infinite number of types of legal relationships you can have with investors. So that's number one, is figuring out what that's going to look like. And then number two, separate from that, is what securities law compliance strategy will you choose? And these are the laws, and these laws exist, as far as I know, in every country, and sometimes not even both at the national and state or provincial level as well. I know in Canada and the US, there's laws at both levels. So you do have to be really careful about what you do when you're looking for investors. You might People go on Clubhouse every day and break the law and talk about, hey, I'm looking for funding for my business. That's often illegal. Not that it's always illegal, but you have to know the law and comply with the right law to be able to do that, if you want to be able to do that. So the legal compliance strategies that are available in the US, there's many, 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 but the main ones are a private offering that allows you to raise money from both accredited, meaning wealthy, and unaccredited investors. That is possible. Um, and then there's your kind of the more well-known way, which is a private offering that allows you to only raise money from accredited investors, which is, wealthy investors. There's also crowdfunding, which is, now legal at the national level since 2016, which allows you to raise money from anyone in the country uh, and publicly advertise. And then there's something called Rule 506C, which allows you to publicly advertise, but you have to limit your investors to just accredited investors. And those are kind of the main categories. There's lots of details within those, and then some others I'm not even mentioning because they're very specialized, but like for agricultural co-ops, for example. But and nonprofits also can raise money from investors, and they have their own special exemption. So anyway, so those are kind of the two main decisions that you want to make from a legal perspective. And sometimes people get confused and they'll say, well, you can raise money from angels or you can do crowdfunding. And that's two different decisions into one pot. Crowdfunding is a legal compliance choice, and it says nothing about who your potential investors might be or what you're offering. Saying I'm raising money from angel investors has nothing to do with your compliance choice. It has to do with who your investors are and probably how they will be investing. So it's just important to understand those are two separate decisions. They're related to each other because what you offer is going to be affected by how you offer it, but they are two separate decisions.
Wow, wow. I think I'm more confused now than when we
Oh
started, but
no.
no, I'm teasing. I'm teasing you a little bit here. I'm teasing, but there's a lot of acronyms and numbers flying around, and um, I understand that. Let's talk a little bit about Reg CF, the regulation crowdfunding. How much money can you raise from that? And so, what are the parameters around that raising money under Reg CF?
Yeah, so regulation crowdfunding became legal in 2016, allowing you to make an offering to investors nationwide, which was not possible before. Before you had to do state by state compliance, which was very onerous. So you have to list on a platform, and there's certain platforms that have gone through a compliance process to be able to be licensed to be a place where you can list your offering. So you can't just go out and do it yourself. You have to use a platform. And then you can raise up to $5 million, which just got increased recently from 1,700,000. The thing is, though, that you do need to be aware of is that if you're raising more that, and they just increased it, I don't, it's something like if you're raising more than 124,000, they just increased these numbers for inflation. You have to have reviewed financials by an independent CPA, and that costs a few $1,000s, we found. And if you're raising more than 1,70,000, you have to have audited financials, which is more expensive. So Many people will start out with a raise of, that up to 124,000. Now, you even there, you still do have to have financials prepared by a professional in compliance with generally accepted accounting principles. So there's definitely some onerous things required to use it, but it's very worth it because once you complete the financials and then complete a whole other set of disclosures, you can post your offering up on one of these platforms and anyone in the country can invest. Sometimes there is a state filing required depending on where you are and where your investors are, but that's usually a fairly simple thing to do.
Is that 1 or 2 years of audited? Do you know?
You have to have 2 years of financials. So, but of
Okay.
course, if you're a newer company, it would just be since inception.
All right, very cool. So this now, if I'm doing a Kickstarter, like I got a product and I want to put it on the Kickstarter, I don't need to file any of these kinds of documents, do I?
Exactly. So Kickstarter is not an investment crowdfunding platform. We call it rewards based or donation based. So that's not a securities offering. It's not regulated by securities law. So it's much less onerous to do that type of an offering.
Okay, great. So we have Damien on stage here. Damien, are you there? He's our CFO for paw.com. We've got Jeff, who's a CMO at paw.com, and I'm obviously a shareholder in paw.com as well. And so it's an interesting case study because I think we're ready. Like we're about ready to pull the trigger. Damien, what are your thoughts, or do you have any questions for Jenny right now?
No particular questions. Maybe if you can just expound a little bit on the differences between Reg CF and Reg A plus.
Sure. So regulation crowdfunding, what you can raise up to 5 million, and the compliance process is fairly easy. You just have to complete a whole bunch of disclosures, file them with the SEC, and then you're good to go. Um, Regulation A has been around for a long time. For many years, it was considered kind of a dead letter because you could only raise up to 5 million, and it is somewhat of an onerous process. And then with the Jobs Act of 2012, they increased by quite a bit how much you could raise. So you can now raise up to 75 million. So there's a revival of Reg A, and then Reg A plus. There's Reg A and Reg A plus. Reg A plus, you can raise more, but you do have to have audited financials. And under Reg A, it's much more onerous. You do have to file something with the SEC, and then they're going to make comments on it, and you're going to go back and forth with the SEC until they're satisfied with your disclosure document. And there are state by state filings that you have to do. Under Reg A plus, they're not as onerous as they are under Reg A, but it's something you would probably do if you want to raise a significant amount of money, because the cost to do a Reg A plus is probably in the range of about $100,000 in legal and accounting fees.
Wow, and a Reg CF is costs how much for Reg CF roughly?
That so depends. It depends on the complexity of what you want to offer. It depends on how good a job you want to do on your Form C, disclosures. But, I would say 10 to 25,000 maybe.
Okay, I have one more question, Michelle. I know I'm being a question hog. Uh, but so
You
so
sure are.
assuming we do a Reg A plus for paw, could we have 1 million customers? Are we allowed to email those customers and tell them we're raising money through this platform using Regulation A plus? Are we allowed to solicit that boldly?
Yes, yes, that's one of the great things about Reg A Plus is you can publicly advertise.
But then if you get like 1,000 shareholders, how do people trade them? How do they, I don't understand. It's almost like you're a public company, but you're not.
Yeah.
But
Yeah,
but
it's
but those
oh, go
sorry,
ahead.
but I was going to ask, but you can advertise, but those customers would still have to be qualified, right? They
No.
would
No, no, they
no,
don't. No, they do not
really?
have to be accredited. Anyone can invest under Reg A. Yeah. Same
Oh,
thing with regulation crowdfunding. Yeah.
crowdfunding. I knew that was the case. I didn't know that was the case for Reg A Plus as well. Okay, cool.
Yeah, if you don't want unaccredited investors, there's a much easier pathway for you, which is Rule 506. in fact, with Rule 506C, you can publicly advertise, and you could start doing that right now. But you would have to make sure all your investors are accredited. If you want to include everyone and not have a test of wealth and income, could do Reg A plus and raise up to 75 million, publicly advertise, and anyone can invest. But in terms of having that large enough, first of all, let's keep in mind that you can offer any type of security you want. You don't have to offer equity. So that's one thing to keep in mind. Your investors may not be getting equity. That would be a choice that you would make. Second of all, if you do want to offer equity, it is true that you could end up with a lot of equity investors, but that's not necessarily a bad thing. I mean, there's many companies out there that have hundreds and hundreds of equity holders, um, and they're just fine. There is sometimes people will go ahead and set up a special purpose vehicle to have all the smaller investors invest in that vehicle, and then the vehicle itself is the investor in the company. So that's another option. It adds a layer of complexity, but you can certainly do that too.
I did that with MoonPay. Michelle.
Wow, there's so many questions that are flooding into my head. So, Jenny, you just mentioned how you could do a special vehicle. Like, if you
Uh-huh.
do one of these offerings, can you limit what any particular investor can come, invest with? I mean, like, could you just make, for example, every, share is cost, I'm going to make this up, $20,000, and you can't own more than 3 shares per person. Are you allowed to design your program in such ways as that to kind of
Yeah.
manage? No.
Yes.
Yes. Okay.
Absolutely. You can do whatever you want. I mean, you probably wouldn't do that because you probably would want to make it accessible to people who could maybe who couldn't invest 20,000, but you can do whatever you want. You can price your shares however you want. You can have caps on how many shares anyone can own. There's so much flexibility in corporate law,
Right.
which is not surprising given the people who control our legislators, right? So we
And
can
then
we can
just
benefit from that.
absolutely. So it's, you can get as creative as you want, but I
Yeah.
think the lesson here is don't do it to your own demise, that such that it's so overly complex to manage or communicate, right? Or to untie, so to speak.
Exactly. I mean, there's always a tension between keeping things simple, but also designing it for your particular situation. A lot of people really they say, oh, I'm going to just use a safe. This has become so popular, a simple
Right.
agreement for future equity, because they're like, I want to just keep it super simple. I don't want to pay a lawyer. But a safe has a lot of implications to it that may not fit for you. So, um, it's probably worth it, given that the way you bring on investors is going to have a huge effect on your company for like maybe 10 or more years. It's probably worthwhile to take some time to think through what exactly you want to do and not use an off the shelf document.
Right. And then one other question as it pertains to counsel. So, for example, we're in Florida. Does this mean that we have to use a Florida bar attorney? Like, what are the regulations on these things? It's unclear to me.
Yeah, good question. I mean, every state is a little bit different in terms of their rules of practice. But I have clients all over the country. Hopefully I know the state of Florida is a little on the stricter side. Hopefully they won't come after me when they hear this. But the securities law and corporate law are very much kind of, there's a lot of federal aspects to it, and also a lot of aspects to it that are almost identical from state to state. Plus, a lot of companies in Florida are formed under Delaware law, right? So, or maybe some other state law. So, generally speaking, I would say you do not have to have a lawyer that's licensed in the state where you're located.
That's very good to know. Thank you.
Yes, you can hire me, even though I'm not barred in Florida.
Excellent.
That's useful. And so everybody always focuses on venture capital. I know this is a decision based on a company's, personal But it seems like venture capital, you do the deal, you win the lottery, you're a millionaire or even a billionaire. They do it, you lose the money, they do a Netflix story, and that's how it seems to roll, right?
And then you get the biggest check in history.
And then you still get a big check at the end of the day. We're talking about Mr. Newman, of course, right? Um, so tell me about like from a legal perspective. I don't know if it's more of a opinions or legal perspective around venture capital. Like when is the right time to do venture capital?
Yeah. So I think there's so much confusion out there about venture capital. I think a lot of people think that venture capital is kind of the only way that a startup can get funded. And so sometimes you'll hear people say either you're venture backable or you're a lifestyle company, which means you can't get funding and you have to bootstrap. And this is so not true. So, venture capital is a very specific type of funding designed for a very specific type of situation. It came about, in the 50s and 60s when, the kind of technology computer industry was taking off. And the purpose of it is to fund very high growth companies that have the intention of dominating a market. And it's definitely used in the technology space. It's also being used somewhat in the consumer packaged goods space, but it's not a fit for 99.9% of companies because most companies are not trying to be the next Apple, Google, Facebook, whatever, and and maybe either don't want to be or couldn't be because that's just not the type of company they are. And that doesn't mean you can't get funded. It just means you should not pursue venture capital style funding because it's not a fit for you. And this can be very confusing because people sometimes say, "Oh, well, I'll just go for angel investors then." But the thing is, most angel investors, active angel investors, are part of the venture capital ecosystem. So if you go for angels, you're pretty much going for venture capital like that. It's the same model. So if you're not a fit for venture capital or you don't want venture capital because it can be very destructive to your company, you can lose control, you can get diluted down to nothing, etc., then there's still a lot of other choices. But most people think that it's either VC, bootstrap, or maybe get a bank loan.
So you talked about dilution, this idea of liquidation preference. Does I know it exists with venture capital? It seems like every venture capitalist deal looks exactly the same. I
Yeah.
think they have the same paperwork.
Oh
It's
yeah,
pretty much
you can
standardized.
see it online. There's a website for the National Venture Capital Association. All the legal documents are right there for anyone to see. There's no mystery to it.
And almost everyone has this concept of liquidation preference where they get the prior rights, when and
Yep.
if the company sells down the road, which is similar to the situation of the company I'm working in where the entrepreneur spent 15 years and is losing the company, and then his
Yep.
chance of recovery is almost 0%.
Yeah. It's
Now,
very common.
is that liquidation preference? I know I've invested in our crowd. They seem to have similar rules for raising money as well. Is it similar when you do a Reg A plus or you do a Reg CF that you would give liquidation preference to shareholders? Is that
Yeah.
common or not common? And then the follow up to that is what platforms could we use at PAW if we wanted to do it without liquidation preference?
Right. So when you are doing crowdfunding or, offering the investment opportunity to people who are not VCs or on the VC model, it's completely up to you to offer whatever you want and design it specifically for your particular situation. So it would be up to you to decide whether to offer a liquidation preference at all, and if so, the details of the liquidation preference. And that can be done on any platform. There's no platform that allows you to offer any kind of security that's going to govern is going to tell you whether or not to offer a liquidation preference. So it's just a matter of deciding, do we want to offer one or not? I oftentimes the way I draft my documents is I don't think liquidation preferences are necessarily bad. If the company sells, the people who put in a ton of money, I don't think it's unfair to say they should get first dibs on at least a 1x back. So the first money goes to them to at least make them whole, right? But after that, then what happens? That's kind of where the devil is in the details, because the 1x liquidation preference is pretty standard for VC deals. But then what happens to what's left over after that? Does it then get divided up? Does the VCs get like a second bite of the apple where they also get a big chunk of what's available after that? And that's where founders like end up with nothing. So the way I draft my documents is I will put in a 1x liquidation preference, but the people who get money after that are the founders.
Yes, so it should be set up where the 1x or their percentage, whichever is greater, right? And then not that they get the 1x and then they also get their equity percentage of the remainder, which sometimes they try to do, correct?
Yeah, I mean, there's all kinds of different ways to set it up, but the way I like to do it is I say 1x to the investors, 1x to the founders on the same, like at the same valuation as the investors. And then if there's anything left over, that everyone shares based on their percentage ownership. Now, a lot of, VCs would laugh in your face if you told them you wanted that, but but if you have the right investors, they're fine with it, especially if your whole model of your business doesn't necessarily depend on an exit for investors to get paid. Because a lot of my clients are like, you know what? I'm not really shooting for a big exit. I may someday have an exit, but I'm shooting to become a profitable company. And when I'm profitable, I'm going to be paying out dividends to my investors. So the investors start getting paid much more quickly, and they don't care as much about your exit because they're getting money in a different way.
It just seems unfair though that these investors come in, they get their money guaranteed, you don't, and um, the only scenario you get your money in is if there's a big success. If there's sort of a stagnant, if the valuation is not, sort of a medium success and you're issuing dividends, but you're not able to, get the valuation above that 1x, you walk away with nothing. It seems like they're not taking the risk. They're putting the money in, but not taking the risk.
Yeah, and it's completely up to you to design that however you want to. And if you have a good argument as to why it's fair and why they will get a reasonable return on their investment, in addition to all the other benefits of investing in your company, people will say yes to that. They won't be VCs, but there's guess what? 99.7% of the population is not a VC and is not part of the VC ecosystem. So that's fine. You don't need to get a yes from a VC.
Yeah,
There's plenty of other people out there.
and maybe it depends on the company. Like for instance, paw.com, it's been now for 4 years in a row one of the fastest growing companies in the United States. We've got 6 7 years invested in it. It's doing extremely well. Why do we need to offer a liquidation preference when we raise money for paw.com? But
Yep.
if it's a new startup and it's Clubhouse, for instance, I totally understand why Clubhouse raised a lot of VC money at the beginning. Totally get it. They had to move to market quickly. And I do know that that is the benefit of VC capital. It's smart money moving quickly if you need a lot of it. And Clubhouse, when they first launched, they needed a lot of money. So they had to move quickly because they were up against Meta, Facebook, and they're up against Twitter, and they're up against Spotify. They had a lot of challenges. I know that we did venture capital at Hostopia when we were launching a hosting platform in 2000, and that was strategic as well. And because it was strategic, we were able to benefit from the business that was generated from actually doing the deal. There were other benefits. So it really depends, I guess, on the type of company and the maturity of the company, and et cetera, et cetera.
Right. And also your plans of how you're going to grow. There's this whole movement. There's this organization called the Tugboat Institute, which is a movement of evergreen companies. That these are companies that never sell. People that start a company and it grows and it becomes incredibly successful, but they're still owned by like the original founders. And their investors love them because they're getting beautiful fat dividend checks every year. So in that case, liquidation preference doesn't matter because they have no intention to sell. So you don't have to sell your company for investors to get paid. There's many ways for investors to get paid.
But let me push back a little bit there, because I do know that when you do a VC deal, typically there's a time limit.
Oh
Am I
yeah,
not
the
correct? six
VCs
years or
do have
7 years?
to.
Okay, so
Yes.
yes, we're not talking about the concept of liquidation preference. You never sell. We're talking about, yeah, that's a VC specific. thing, they generally have these time periods where you have to
Oh,
sell by
they
a certain
do.
date,
That
or
is part of the VC model. The VC model is, if for you to be a success, you have to have a big exit, ideally within 5 to 7 years, because what the promise that they've made to their investors, the limited partners that invest in the VC fund, is that you're going to get paid out by the year 10, and you're going to make like a huge multiple on your original investment, so that they have to push you to do that, and that's the goal. But if you don't have VCs investing, you don't have to do that.
that's
Along
funny.
similar lines, Jenny, just a question. I experienced this once with a company that I was involved with, where they had given one of the principal investors, also a VC fund, not only did they have liquidation preference, but they had the right to approve the sale of the company if the offer was below a certain amount. So they had a threshold that
Yep.
anything above that threshold, the founders could go ahead and make the deal, but anything below that threshold, they had to approve it. And in this particular case, that really led to the demise of the country because that investor was particularly greedy. There was a very good offer from a very good buyer, but it didn't meet that threshold, and the investor did not allow the deal to take place. And then eventually, no deal ever took
Yep.
place, and the company
Yep.
eventually went bankrupt.
Yeah. VCs have these in the term sheet. They have these things called protective provisions, which gives them the right to approve just about any major decision that you would make. Raising additional money, selling the company, amending your charter, all kinds of things. And so, yeah, you're,
Salary too.
um, I haven't so much seen salary. Um, but yeah, you can go look at the NVCA website and see the long list of protective provisions of things that they have the right to approve. So yeah, it's you're pretty much, as they say, when you get a VC, you're getting your boss. They become your boss, and that's true. So, of course, then they have a board seat usually, so they're going to be really dictating what you do with your company, and they don't always make the best decisions. My husband was working for a really great company. The investors, made some decisions that ended up destroying the company, so he had to move on. So, um, this happens. So that's why I'm not a huge fan of that way of getting funding.
Right. What's funny, Jeff, you're talking about that the clause, like, and when Hostopia, we raised the VC, we had the VC funding in 2001, and they had, you're right, they had the ability to block us from raising additional money, but we had one clause that said if we do a liquidity event or an IPO, then they couldn't block the transaction. There were still two board members on the board who voted against Hostopia doing an IPO. Fascinating little bit of history there, like, or case study, to see that your VCs, because they knew they lost control once you did IPO, they lost
Mm,
all that control, all that
that
power
is
just went
right.
away. And it was a small IPO; it was only 30 million. It was a Canadian company, right? But still, it just, they totally wiped them out, and I thought that was pretty cool. All right, moving over to crypto, because Michelle and I have a meeting at 3 o'clock today with a gentleman who's done a Reg A plus, and he is issuing tokens for real estate. He has a real estate fund. And I don't know how much he's raising and whatnot, but it's pretty cool because we have a meeting in like 25 minutes. So I'm really going to be ready for this meeting now, right? So tokens, like, do these crypto offerings require the same legal requirements as if doing a regular offering, or are they somehow getting around it by doing a coin?
Mhm. Yeah, so this has been a very hot topic in the world of securities law. Are these things securities? Because if they meet the definition of a security, it's definitely regulated under securities law. And there have been so many of these ICO, a few years ago, there were so many ICOs where they said, oh, it's not a security, it's a coin. So we're going to just raise billions of dollars selling this coin. But it definitely was a security, because the definition of a security is basically anything that someone would put money into with the expectation of making a financial return. And even if you say like, oh, these coins are, their currency in our game, or something like that, if you're putting the message out there that the reason someone would want to buy this thing is because it's gonna increase in value, which is generally the reason why people buy them, then that's a security, and it's definitely subject to securities law. And there's a lot of crackdowns happening right now for that, for the things that happened 5 years ago. The SEC can move a little slow, but the long arm of the law will eventually catch up.
Can't I just slap an ape image onto it and call it an NFT? Right? Couldn't I just call it an NFT? Here's an ape
Yeah, there
image.
is an exemption for things that have ape images on them. I'm just kidding. That's a securities law joke.
I am laughing on mute here,
Anyway.
so
So yeah, no, they're gonna look to the actual realities of what is being said to people that's inducing them to put money into it. It's just, if people are pouring money into something, it's probably not because they get to buy a t-shirt for their avatar on your game. It's like they're pouring money into it because they expect to be able to sell it someday at a huge multiple, and if that's the case, then it is a security.
all right, great. Well, if you're in the audience and you're thinking about raising money, or again, you have a question for Jenny here, this is a rare opportunity for you to really dig in and think about your own business, where you're at, and whether or not you want to raise money and what that would entail. And she's on stage here, and she isn't charging any of us anything. Thank you very much, Jenny. But I really appreciate that. Damien, I don't know if you have any more questions, or Jeff or Michelle, because I'll keep going. Damien?
No, I'm all set. Thank you. I appreciate it.
Yeah, all right. All right, so then what are the consequences? So if someone actually does raise money and they don't do it correctly, are we talking a fine? Are we talking jail time? Like I don't know. Is this an actual serious offense? Or is this like you didn't pay your taxes or something? I don't know.
It can be pretty serious. I mean, at a minimum, if you're found to have violated securities law, at a minimum, you do have to offer all of your investors the right to get their money back, and they can also sue you to get their money back and demand, get damages and interest and all of that. If you really are a bad actor, it can go beyond that to the point where it could be criminally prosecuted. If you did it with the intent to defraud people.
And on that note, like when we did our dot club company, we raised $7 million through my LinkedIn contacts, and we did a Reg D. That's a 506C. Is that what? I don't know if that's what you were talking about.
Yeah, 506C probably is what you did if you publicly advertised and included only
Yeah.
accredited investors. Yep.
And we did a private placement memorandum. And
Hmm.
I just wanted to ask, is that something that is normally done on every investment? Or like what would be the benefit of doing it or not doing it?
Yeah, so it's not legally required. What is legally required is that you disclose to all your potential investors any material information that they would want to know before making an investment. So if you have a big lawsuit pending against you and you don't mention that to investors, they will have a cause of action to sue you, because they need to be given all the information that would be material to their investment decision. But you don't have to do that in the form of a private placement memorandum. I mean, the purpose of a private placement memorandum is to really have a formal way of disclosing every possible thing that you under the sun that you could think of that investors would want to know. And it is almost funny sometimes when you read them, because they'll have things like, yeah, if there's like a nuclear war, we would probably go out of business, just so you know. you know so they're kind of these overly legalistic documents. They're like CYA documents, to make sure that you can say, I disclosed everything of material nature to the potential investors. But you don't have to do it.
Yep.
Either, as long as you make sure you do disclose everything that people need to know, you're fine.
I know. I think we had some of those crazy risk factors
I'm sure
stated.
you did.
When we did our S1 for an IPO, we had to do an S1. Man, that was complicated and very expensive. I think we spent $1.8 million on legal fees and commissions or whatever it was. It was a lot of money spent. I know we spent about 20,000 when we did the private placement memorandum. What I did find is it took like we had to raise $7 million in 30 days, and it was like what it did really what I thought it did well is, and people did know me, but what it did, it created an intangible, this concept of this investment, and almost made it tangible. And the document almost looked like an S1. You know, it had the nice front page and everything. And when you send it to someone, it's like, holy shit,
Yeah, this is
these people
serious.
they got their act together. I'm putting my
Yes.
money into this company. So there's a little bit of a marketing benefit
That is a
to it.
great point. I think you're totally right about that. It gives it so much more credibility that you took the time to really do it right. Yeah, I agree. That's a really good point.
Well, we have Wesley on the stage. Welcome, Wesley, to the Serial Entrepreneur Club Hour. Do you have a question or a thought? Are you raising money? You want to share with us anything on this topic?
Yeah, I mean, I'm currently just started a cat litter business, and going to Jenny's point, you know, people and I've seen it across all industries. Somehow or another, greed gets in the way, and that's what topples everything. If you're not in the position where you're looking to grow a business and your mindset is to employ people and give them uh you know give them a lifestyle, but your mindset is, no, I'm going to rape every investor and then topple the company. But yeah, that's what I'm doing. I'm trying to raise money to start a eco-friendly, biodegradable cat litter company.
Great. I'm a huge cat lover, so thank you for doing that. um, yeah, I mean, the whole topic of what is considered a reasonable return on investment, what is a market rate return, and then what is a return that is really kind of greedy and extractive is a very interesting topic. People have so many different opinions on that. I was just recently talking to someone who these foundations that claim to care so much about underrepresented entrepreneurs that don't have access to capital, and they're patting themselves on the back offering loans via a certain crowdfunding platform at a 13% interest rate. And these are foundations with a mission to do good in the world, and I was just shocked that they would feel proud of themselves that that was the return that they were expecting. And I actually did ask them, like, isn't that kind of isn't that high? And they said, well, we have to make market rate returns. Even though we're a foundation, we have to make market rate returns, and these are very high risk loans, you know. So it depresses me quite a bit that there's greed in every sector of our economy. And at the same time, I don't want to demonize people because there's so many factors at play. I mean, for example, if you are running the financials of a foundation, you know, you may be a financial professional and your bosses may be breathing down your neck saying you better not lose money. You better make a 13%, you know, you better charge a 13% interest rate because these are risky loans. So, you know, there's many different perspectives on this topic.
13%. I know there was a Shopify loan I know a company did, and once Black Friday hit, it automatically, because you would pay a percentage of your revenue. And I did like
Yes.
the calculation of interest. It was like 60-70%.
Yes,
It
these
was
revenue-based
absolutely, this is
loans are,
Shopify.
yes.
This was insane. This is usury. I mean, I don't know. What? Oh, cats. By the way, Wesley, Michelle, you two should definitely connect. Michelle's got about 1 million followers on Meowingtons with one of her e-commerce companies. So hopefully your cat litter would do well on Meowingtons, Wesley. Um,
Well, the
eh,
deal is, I mean, seriously, this is when you look at the market trajectory in the cat litter market. And this is how I got into looking at the cat litter market. My mother's almost 80 years old. She'll be 80 next year. Well, she can't carry a bag of cat litter anymore. It's too heavy. It's like a damn sack of concrete. And then when you look at really what goes into, maybe I'm getting a little off topic here, but when it goes into the mining and the ecological destruction in the cat litter market, a lot of these new cat litters that are coming and emerging in this, they're waste products in the agricultural market. Corn cob, for example, sorghum seed. I mean, a lot of this is, yeah, the problem is, and it's always been, two things I don't possess. I don't suffer from greed, and I don't suffer from anxiety, or not anxiety, but yeah, that's the problem that stumbles everything when you're trying to go into business. Oh, greed and amnesia. That's it.
Well, you proved it right there. You had amnesia for a second. All right, that was funny, Wesley. That was really good. But we do want to stay on topic, and if you have any more questions in the audience of Jenny about, or you're interested in raising money for your business, please again raise your hand. Come on stage. It's Friday afternoon, and we got 15 minutes left. 15 precious minutes. Jenny, when you do file a Reg CF or Reg A Plus or Reg D or any of these, is there a time limit? Like you have to do it by? Does it expire? Do you have to raise all the money or you have to give the money back? Are there any other rules like that?
It depends. With Reg CF, you generally are going to set a close date for your offering. And you have a minimum target that you have to reach. So let's say you want to raise 500,000, but your minimum target is 100,000. If you reach 100,000 by your target date, you get all the money, or anything above it. So that's generally how it works. I mean, there's other things you can do, like you can extend the deadline. If you don't reach your goal, you can extend. You can also have rolling closes, where you can, even if your target is, 1 million, you could have closes at every 100,000, so you could pull money out before you reach that full million.
Hey, Jenny, are there any other financing fees or underwriting fees associated with a Reg A Plus?
Not necessarily. It just depends. I mean, there's some, actually, I don't, I assume there's a filing fee. I can't remember what the filing fee is with the SEC, but it's not high. So that's not
What
an
about the
issue. But if
platform,
you,
though? Do they take a fee?
well, you don't have to use a platform for Reg A Plus. You do have to use a platform for Reg CF, but not for Reg A Plus. So you can use a platform, but you don't have to. So, and of course, you can also use a broker, but you don't have to. So there's no required fees, but if you use some kind of an intermediary, there would be a fee.
But if you did use it, do you know what generally the fee would be?
I don't. I assume it's, somewhere around, 5 to 8%.
Yeah, see, that seems like a lot.
It's someone that you had asked, I think Colin or someone had asked about the time frames and stuff, and I think earlier someone mentioned SPACs, special purpose acquisition corporations, and I think SPACs have very specific time frames because I think just recently, famously or infamously, some big SPACs that had been raised by some pretty high profile people had to give back the money because I think it was 2 years had passed and they hadn't found a suitable company to bring into the SPAC. Is that correct, Jenny?
I don't deal with SPACs because I don't deal with public companies at all. I specialize in private companies. So the whole SPAC thing just seemed like such a scam to me when it first started. So I never did get very involved. Although I do have a friend who's done some SPAC deals, and I think there are some out there that have, that are worked well and made a lot of sense. But and just for those who don't know, a SPAC is a situation where you raise money for kind of a shell company with the intention of using that money to buy a company, and you don't know exactly what it's going to be. So it's the investors are kind of taking a big gamble when they're investing. So I don't think that's a super great model. It's very risky for investors, and there have been some crackdowns on it recently.
Now, I thought it would be an opportunity here for entrepreneurs or startups who are at a certain stage in their business to go public versus relying on the venture capital. See, right now, because of Sarbanes-Oxley and the regulations and whatnot, you can't do a $30 million IPO anymore. You need to be $1 billion company plus, and even then, that's questionable now. Where SPACs, I thought, would create that opportunity for businesses to go public, gain liquidity, but still be a smaller entity. And I thought it was going to shake out that way, and maybe it still will. But I just find it's so hard in the United States to actually go public. It's almost impossible. Whereas in other countries like UK or Canada, smaller companies actually do go public, and we do actually have investors, and people do trade stocks in smaller businesses. So I thought the SPACs would help with that, but what happened. I guess there's a lot of scams, just like you had with the ICOs and everything else in the past.
Yeah, exactly. Um, Gosh, you reminded me of something to say about that, and I can't remember. Going public. Oh, I know what I wanted to say. um, yeah, because very well-intentioned laws have gone into effect over the last 20 years to protect investors. Like Sarbanes-Oxley, but because of those laws, it has become so expensive to be a public company that we now have, I think, about a quarter of the public companies that we had before that all those new laws went into effect. So many companies are going private because they just can't afford the costs of being a public company anymore. So that's kind of a bad consequence because now our public markets are much less diverse in terms of what's actually in there. When you invest in the stock market, you're investing in a much smaller, pool of companies.
And I guess the flip side to that is the introduction of Reg CF and things like that, which is another way then for John Q. Public or Jane Q. Public to be able to invest in private companies that normally wouldn't be available to them.
Exactly. Yeah. I mean, the vast, vast, vast majority of companies in our country are not public companies, meaning they're not, those companies that trade on stock exchanges or, they do. Public companies have to do quarterly filings. They're the good thing about them is they are required to disclose a lot and they're highly regulated, but there's so few of them that if you invest on the stock market, you're really not investing in the 99.99999% of our economy, which is unfortunate. That's why there's such a huge lack of capital for private companies, because it's so much of it is on in the public markets.
It seems like we had a question in the chat about NGOs. If you're raising money, I think for a not-profit, do they have to file these documents as well, or is there a whole different set of regulations around that?
Yeah, so this is one of my favorite topics, the idea that nonprofits can raise money from investors, because I've done it myself. I raised 1.1 million from 135 investors for a nonprofit offering of debt for a nonprofit that it makes investments in social enterprises. So if your nonprofit does revenue generating activities, it might make sense to raise money from investors. Um, there is a federal exemption from securities filings if you are a nonprofit making a securities offering, but you do have to check your state because every state is different on the nonprofit thing. So I've had clients, for example, in Massachusetts. That's one that comes to mind that's very liberal. So if you're in Massachusetts, you're eligible for both the federal nonprofit exemption and the Massachusetts nonprofit exemption, which means with almost no filings at all or fees, you can publicly offer an investment opportunity as a nonprofit to residents of Massachusetts if you're in Massachusetts. So it's a great tool.
And now with Reg CF, Reg A plus, Reg D, do you have to get approval in each state as well?
No. Well, some yes and no, depending on which one you're talking about. So,
All
Reg
right, help us
CF,
here.
what was that?
No, I said help us again. Tell us what yeah,
Oh,
what we
yeah.
have to do. Yeah.
Yeah, I mean, state level compliance, it really varies. So, with 506, with Rule 506, which is part of Reg D, you don't have to get any state level approvals, but there are state notice filings that have to be filed. With Rule 504, which allows you to do a private offering to anyone and does not restrict you to accredited investors, you do have to do state by state compliance. For nonprofit exempt nonprofit offerings, you do have to do state by state compliance. For Reg CF, you don't, but you may have to do a state notice filing depending on which state you're in and where your investors are coming from. With Reg A, Reg A plus, there are state notice filings that are, I think, somewhat expensive and onerous because many Reg A offerings are not, they're not available in all states.
Oh wow. And if PA were to go forward and we wanted to use a platform, I know there's our crowd, Start Engine. Am I missing any other ones that you might know about?
Um, I think most of the Reg CF platforms also allow Reg A offerings, so there's probably a ton of platforms you could use.
God, okay. You don't have a favorite then that you'd recommend people use?
No, I don't.
No, okay, so stick with the legals. All right. Well, this has been fascinating. I don't know if anyone else here has a question or a thought before we close it out here on the stage. If not, thank you very much, Jenny. And I also mentioned to you that we signed a publishing deal with Forbes to put out the book, the anti, would you call the Greenfield, the anti Greenfield book called Start, Scale, Exit, Repeat. And we'll hopefully some of the information that we got from this session will also be put into a chapter in that book. So thank you very much for everything you shared with us today. It was incredible. I learned a lot. Damien, do you think do we learn something here, Damien?
Yeah, absolutely. Thank you so much, Johnny.
Sure. Would it be okay if I shared a something before we sign off?
Absolutely. You have 3 minutes, so go for it.
So I am having a 3-day event where we're going to be doing a deep dive into all of this. It's called Raise Capital on Your Own Terms, Build It, Fund It, Grow It. And if you're listening right now, we do have a discount code for 20% off the fee to come to the event. It's a virtual event, so you can come from anywhere. So if you use today Jenny 20, Jenny, and then the number 20, if you go to my website jennykassan.com, you'll see a pop-up there or a something. You'll definitely see the event there. Click on the link. The event, it's $197 for the 3 days. And if you use Jenny 20 today, you can get 20% off.
Oh, it's
Sounds like
unbelievable. I
a
can't believe
great
it's
deal.
I know, I can't
Thank
believe it's
you.
that cheap, but
Oh my
I know,
gosh.
that's
crazy, right?
amazing. That's amazing. And they can get in contact because we also put this out in podcasts as well, but they can get in contact with you from your website, Jenny Kassan. Can you just
Yes.
spell that, the radio test here for us, jennykassan.com?
Yes, it's JENNYKASSAN.com. And we do have a ton of resources there, things you can, download and use to get you started on figuring out your plan for fundraising.
And also a book. We can go to Amazon. You came out with a book. What's the title of the book again?
Raise capital on your own terms, how to fund your business without selling your soul.
Wow, it's amazing. Amazing. What a great hour. Right, Michelle?
Fantastic. And I see Mimi is in the audience. We can do a little post about your seminar as well. So we'll touch bases with you, and we'll just say it's a special code for all of our members.
Thank you so much. Yeah, and feel free to reach out to me via Clubhouse or Instagram, but yeah, probably website is best.
Awesome.
Okay, great. Thank you so much. I really enjoyed the conversation.
Have a wonderful day.
Absolutely.
Bye.
And we
You
really
too.
have a wonderful day, everybody. We really want you to follow us on Startup Club. We have two phenomenal authors. If you go to startup.club, sign up for our email list. We'll tell you who those authors are. in the next coming weeks. Two very famous authors. So please sign up to that mailing list. Thanks again, Jenny. Bye for now.
Bye.